One of our previous real estate syndication deals we offered to our passive investors group, that's actually a group of accredited investors. You can find the link below the video if you want to join. One of these deals was an RV park down in Mississippi that was actually structured in a way that after only 24 months, we were planning on refinancing out up to 80% of the initial investment. Now, as you can imagine, this brought up several follow-up questions, with many of them involving, you guessed it, taxes. Specifically, how was this potential refinance was going to be taxed? We also received another question from a member asking if they should actually sell their rental property now or hold on to it indefinitely. And we're going to tie all this in regarding the refinance part. So to illustrate, let's use something that we can very easily walk through today to kind of bring this home. But before we do that, if you're new here and you want to learn about passive income and you don't know anything about it, do me a favor and download the link below the video. All right, so when I went back and reassessed the question, the person was asking in our group, should they actually sell their rental property now or hold on to it forever? Now, when I took that to my group, their initial thought was to simply refinance the rental property rather than sell it. So let's start off by answering that question. Should I sell my rental property today? Well, if you decide to do this, then you have to pay taxes on the capital gain, right? So if you sell and you say yes, then you have to pay capital gain taxes. Now, something else you could do is you could actually exchange it, do what's called a 1031 exchange to actually avoid taking a tax hit during the sale, which would mean if you did this, that means you have to do one exchange for another. So you do avoid tax hit, but you must exchange it with a new property, which right now in this current market, it's at the peak of the market, which really isn't ideal. I mean, if it was a down market, it would be more ideal. Now, a 1031 exchange is where you swap one rental property for another. It's called a like kind exchange. So it's one property like the other one, meaning it must be equal to or more in value in order to facilitate it. So the dilemma is, should I sell the property, pay the tax, or simply hold on to it and continue to cash flow? So again, to illustrate this, let's walk through an example to make it easier to understand. We're going to use good old Dr. T. So Dr. T, he back in 2016, he bought a property for 90 grand. He put down a down payment of $27,000. Now, over the course of 5 years of holding this property, he had to do some improvements like a new roof, HVAC, things like that. So he put 27,000 down, and then over 5 years, he ended up spending 15 grand. All right. At the time of us looking at this situation, he was getting around $1,650 a month in rent. And then it was actually cash flowing $950 a month. Now, realize this $950, this does not take into account the repairs and the maintenance that he was having to pay. All right. So this particular property generates a rental income of around $950 a month. And if we disregard the repair and maintenance costs, think about it, that's a pretty solid cash return, right? It's a pretty solid cash on cash return, which leads us into figuring out what is your cash on cash return. Now, simple way to do it, here's the formula right here. You've got the cash flow, which is the 950 times 12 months out of the year is $11,400. That's what this property is getting in cash flow a year, about 11.5. All right. So then now you want to take so cash on cash return. What is the return on the cash that this gentleman has put in, Dr. T? Well, how much did he put in? Well, remember we talked about he put down 27 grand, and then over the past 5 years, he's put in 15. So 27,000 plus 15,000 is $42,000. All right. So in order to get our cash on cash return, we take the annual cash flow, which is $11,400. We divide it by the amount of money that he put down, 42%. So with this return, now think about the stock market, you're getting what, 4, 5, maybe 6%, maybe 7 on a good day. Then you got to pay taxes on it. With this, with putting down 42 grand, his cash on cash return was a whopping 27%. Try getting that in the market. I don't think so. So Dr. T decided to check with his local real estate agent about, it's been a while, it's been 5, 6 years, about his property. Lo and behold, he was very pleasantly surprised because his real estate agent said the new appraisal for this property would be $260,000. He was shocked, but with inflation and everything else going on, didn't really surprise him that much after he really started thinking about it. So now let's back up. He owes 61 grand. All right. So bought it for 90, put 27 down, paid off a little bit. At this point, when he's evaluating the situation on his $90,000 property, he owes $61,000. Okay. Because the new value is $260,000, this means at this time he's got $199,000 in equity in a property that he put 27,000 down on. All right, so now in this situation, the big question then becomes, should he sell and face the tax consequences or continue holding the property for its cash flow? Now, most of the investors in our group, when we brought this to them, recommended that he go ahead and refinance out instead of selling and paying the taxes. Now, if he sells at the current price, if he gets 260 grand for it, so here's one option. He sells for 260, and after deducting the purchase price, so the original price was 90 grand plus we figured up that he'd already taken about $18,000 in depreciation. So if you take all of that off, that's his basis. He'd be ended up with a taxable gain of $187,000. He's going to be taxed on that. So if he's based on his tax bracket, he's going to owe, if he sells, 40 grand in taxes. On the other hand, option two, the refinance option. So if he refinances out, let's say at a 70% loan to value, all right, he could get a loan. So it's got to be 70% of the value. So remember the new value is 260, so $182,000. Okay, so if he refinances out 70% loan to value, then he's going to get from the bank $182,000. What can he do with this? Well, remember he still owes 61 grand. He could take the 182, pay off the $61,000 loan, which leaves him with $121,000 left over. All right. Here is the kicker. This amount is tax free. Jeff, why is this amount tax free? How does this happen? He put down 27,000. He put down 15 grand on a property. So he's all in for $42,000 over 5 years. And now you're telling me he can walk away still having the property, still having it cash flow with $121,000? What you talking about, Willis? Well, when you learn the tax game, this, my friends, is tax free because it's a loan. Okay, it's not income. It's not considered income. It's considered a loan. Loan proceeds are not taxable. Let me repeat. Loan proceeds are not taxable. And again, the key to building wealth is to constantly learn how to play the money and tax game, right? And here's the important thing to know. When you refinance a rental property, the cash that you get is tax-free because you still own the property, right? It's not a sale, and thus there's no taxable event. This is exactly what the ultra wealthy do. This is what the billionaires do. They refinance their assets to fund their lifestyles. Why? They don't pay any tax. They don't sell anything. They hold everything forever. They avoid income tax. So when you hear the government always talking about we're going to tax the rich, we're going to tax the rich, they don't care. Why? They know how to play. So in Dr. T's situation, he's got 121 grand from the bank that he does not have to pay taxes on. He can take it, park it in a high interest money market account, savings account, or he can go and put it back to work for him, buying more real estate. Now, everything that you do, especially in real estate and investing, whatever, there's always risk, right? And one of the risks with refinancing, there could be a potential drop in the real estate market, resulting in a loan. So he could actually have a loan that's actually larger than the property value. That's one thing to look at. So you have to kind of figure out, this neighborhood that he's in, is it growing? Is there good quality tenants coming in? Are they able to, raise their rents, or is it declining, more people moving out? So you kind of got to look at the situation, because as you know, the most important thing about real estate is location. Also to consider in the situation, after the refi, his monthly note's going to go up because now he has a larger loan, right? But here's the thing, that's going to eat into his cash flow. All right. So after the refi, actually his monthly note, it went up $500. So if it goes up $500, it's going to eat into his cash flow. So now his cash flow is going to be $450 a month, which Still solid cash flow, right? But you also have to consider that, okay? It still provides stable income, and it would still, in this situation, make sense. It would still make sense about continuing to hold on to the cash flowing property, cash out, take the 121 grand tax free, do whatever you want with it. All right, now a little bit earlier in the video, we touched on a very powerful tax strategy the wealthy use called the 1031 exchange right here. If you want to learn more about it, check out this video over here and I'll give you all the explanation you need to know.